Welcome back to Indianomics and to our analysis of the third quarter and the FY19 GDP numbers. I'm now joined by Sonal Varma, the Chief Economist of Nomura, India, and Pranjul Bhandari of HSBC. Ladies, thank you very much for joining me. Sonal, should we be regretting that the GDP for the third quarter has come in as low as 6.6 and could come in as low as 6.4 or 6.3 for the fourth quarter? Or do you think things are troughing out?
Hi, Latha. It's in line with our expectation. I think what we are clearly seeing is a slowdown, but beneath the slowdown, there are sectoral divergences. So clearly investment side has held up while the moderation is more because of government consumption and to an extent private consumption. But sort of looking ahead, I don't think the macro policy changes we have seen, the impact of that is going to be visible that fast. Of course, there are transmission lags, and therefore we do think that the final quarter, the fourth quarter growth number, as well as the first quarter FY20 number, will be in the 6 to 6.5% range. So our expectation is that at least for the next 6 months, one should expect a further moderation in the economic cycle before things start looking better.
Okay, Pranjul, before I ask you all, both of you all, what this means for policy itself, what are your key takeaways from the wealth of GDP numbers?
Well, look, yes, this is a slowing number. After a year, the GDP growth has fallen to under 7%, and the fourth quarter, as per CSO's numbers, will be even weaker. Jan to March will be 6.3% growth, as you highlighted. But I think I don't think we should look at the story only from that lens. I think there's another lens which is very important, that there are some positives out there too. For instance, in a seasonally adjusted sequential basis, quarter on quarter, growth actually improved in this quarter. That's one. Second, the core GVA number, which is basically GVA minus agriculture and minus public services, which we use as a rough proxy for private sector, actually rose in this quarter to 7.1% versus 6.9% in the last quarter. And we actually also see from other sectors, for example, PMI services, PMI manufacturing, that things are not that bad in the private sector. Things are actually improving. So I think these things should be kept at the back of our minds. Also, if you look at some of the details of GVA, for every bad news, there's something which looked better than before. So for instance, agri was very weak, but on the other hand, construction was very strong, and we attribute it to roads, housing, and the building up of toilets in the country. Even on the expenditure side, consumption was weak on the private and government side, but on the other hand, investment was strong. So, we shouldn't completely get carried away by a negative narrative is what I'm trying to say.
Fair point. But, this seems to somewhat fly in the face of anecdotal evidence. Sonal, how much positive should we take from the consumption of what 8.3% private final consumption and even this capex number? Look at the auto sales numbers that we got for November and December. Look at the broken state of the debt markets, the falling credit numbers. So are these to be relied on, or should we look at this anecdotal data?
I mean, I think, as has always been the case, we should look at this and supplement this with the anecdotal numbers. I agree with Pranjul that the quarter-on-quarter number is better. However, if we compare this to actually the strength we had seen in the Jan to June 2018 period, the quarter-on-quarter seasonally adjusted number was actually running at 2% QOQ. That's a 8% annualized growth, whereas in the July to December period, the number has been about 1.2 to 1.4%, which is on an annualized basis, actually, even in the latest reading, in the 5.5 to 6% range. So I think the overall momentum has clearly moderated. The second point I would make is, how sustainable is the consumption demand. Of course, it's slightly slower as per the GDP numbers, but like you said, Latha, the high-frequency indicators are suggesting that the slowdown is much worse. But more importantly, I think how sustainable is the investment strength. And there we do have our doubts that this is going to sustain, because what has changed is clearly the export cycle, which is now globally turning down. And historically, the export downturns have been linked to a slowdown in the manufacturing cycle and in the investment cycle as well. And not to forget that, for at least, the first half of 2019, there is political uncertainty, which is going to mean some delay in investment projects that get announced. And I think financial conditions are still tight. So our view is, yes, investments have been strong, but the sustainability of that is in doubt.
So would you root for 2 more rate cuts, Sonal?
Well, I think, we are expecting another cut in April, and we see a probability of 1 more after that. I think 2 things here. One is the RBI's growth projection, which is 7.2 FY19 going to 7.4 FY20. FY20 numbers we do think are too optimistic. Our own expectation is that the number is actually going to moderate from 7 to around 6.8. So directionally itself, we see numbers coming down, not going higher. And second, the average inflation for FY20 and even the year ahead projection is still looking sub 4%. So 1 more and potentially a probability of another after that.
Okay, but Pranjul, is there any chance of 50 bips in April at all? What are you penciling in after looking at the growth numbers?
Well, right. Look, as I said before, don't want to get too carried away. Right now, we do have a 25 bips a rate cut in April, and after that, a hold. And I will sort of stick to that for now. And I'll tell you why I think so. A lot of the growth slowdown that we are talking about right now, I think they are a result of yesterday's problems. The fact that oil was at $85 a barrel in 2018, the fact that NBFC problem was fresh in the month of September and October in 2018, both of these have sort of softened now, at least a little bit compared to then. Also, the fiscal policy expansion that we are seeing, monetary easing, 25 bips in February, 25 more in April, all of that could support growth in the second half of 2019. I think the short-run concerns on growth are overstated. But on the other hand, I think the long-term concerns are not being acknowledged properly. India's potential growth is stuck at 7%, yes, and nobody is talking about how to revive the investment cycle meaningfully to take it closer to 8%. I think that's where the debate should move at this point, rather than, one extra 25 bips or or 25 versus 50.
Now for the larger question that Pranjul is raising, Sonal, and I want to ask you as well about that. Government contribution to capex is already dwindling. Government final expenditure has not done very well in the third quarter, is expected to do even more poorly in the fourth quarter. And now we are seeing large farm income transfers or loan waivers when it comes to state governments. I mean, capex has gone for a toss as far as the government is concerned. Should this be a longer term worry, as we venture into FY20?
I think that is clearly, one of the biggest concerns we've had, for the last 5-6 years in terms of when the investment cycle will pick up. Now, on the government side, like you said, the composition of spending is clearly moving towards consumption rather than capex. So whatever capex expenditure in any case has been off balance sheet, driven more by public sector companies, and that perhaps will continue. But the on balance sheet spending by both the center and the state government does look like it's going to come down. So overall, public sector capex is unlikely to meaningfully improve. So that brings us to the private capex side. I think, the question to ask is, do we need capex, and do companies have the ability to do capex? The ability aspect becomes a lot more important given the balance sheet deleveraging that's still going on for the capex heavy sectors like infrastructure, construction, etc., telecom. And therefore, for them, growth is not necessarily a priority. It's more balance sheet cleanup. And I think that process is set in motion because of the bankruptcy code, etc., but it's still a work in progress. And if some of these projects and companies are available via the IBC procedure, I think the question to ask is, why wouldn't companies do brownfield capex rather than put up new plants if you can just buy something? So I think in the next year or so, particularly given the domestic political uncertainty, given the need for balance sheet deleveraging, and given the global capex cycle, which is also slowing down, I think it's quite unlikely that over the next 12 months we see a capex revival. But if we do set the balance sheets in a proper, foundation, then at least we create the space for capex to pick up. If not in 12 months, then at least, after that.
All right, ladies, let's wait and see how things pan out. It's quite clear that the government is not lifting the capex mantle, but it's taken over the consumer mantle. Let's see if private sector rises to the occasion. Thank you very much, Pranjul and Sonal, for giving us your understanding and analysis of the GDP numbers. That's it on this edition of Indianomics. Thanks for watching.